in this video, we're going to go over the balance sheet and the income statement and how they're laid out. So on the balance sheet, we have assets on the left side, liabilities and owner's equity on the right. When you're looking at debits and credits, so debits on the left, credits on the right. But I wanted to draw your attention to how this actually works when you're looking at the balance sheet in an accounting system. Assets always equal the combination of liabilities and owner's equity. Logic behind that is that the liabilities and the owner's equity plus what converts from the income statement down into net income or retained earnings in owner's equity is what creates that balance. So assets, liabilities, anything that was entered into owner's equity or carried over from prior years, plus the net income, which goes into that section and makes it balanced. So assets always equal liabilities and owner's equity combined. All right, so now that we've got the balance sheet down, we're gonna look at the income statement or the P&L, profit and loss. So we've got pretty standard debits on the left, credits on the right, revenue is on the right, expenses are on the left, in general, all the way down. But when you're looking at both the balance sheet or the income statement, you are not going to see them on the left or the right. They're just going to be in one report straight down. You only see the debits and credits if you drill down into them in the accounting system. So on the income statement, you'll just have basically revenue as the positive, and then all the expenses underneath are going to be negative. So it's basically eliminating the cost from the revenue, and that's where you get the profit or the loss for that period. So in the income statement, you have the section of revenue at the top, which is basically product sales, service sales, anything that is money coming in for something you do or provide in the business. Revenue section is usually relatively simple, but a lot of times you want to split out different types of products that are being sold or different services that are sold and have a different breakdown there. Now, you get down to expenses, and in expenses, you have operating expenses, which are cost of goods sold or services, and general operating expenses. So they are separate sections, but they're both in the expense part of the income statement. So cost of goods sold is going to be first, but you can also call it cost of services. And that's because you might want to understand what the direct costs associated with the revenue are for services, but for tax purposes, you're not going to have a cost of services. You can still have it in your accounting system, but they won't necessarily file that as cost, because for tax purposes, cost of goods sold is only used if you're actually selling products. So that's the difference between the two. Now, general operating expenses is going to be everything else. So office supplies, rent, any kind of tax licensing like sales tax, excise tax, all that stuff. Basically all the tax stuff that's not income tax, as well as different softwares. Like there's so many different kinds of expenses, travel expenses, stuff like that. So these are all in the operating section of the P&L. So you have operating income and you have operating expenses, which are cost of goods sold and general operating expenses. Then you have another section at the bottom of the P&L, and in that section, it's non-operating. So this is outside of the course of normal business transactions and business operations. So this is going to be things like other income and other expenses. So the income would be like interest income, not to be confused with late fees on invoices. So I've seen that mistake a lot of times. This is interest related to some kind of financing that you're providing to someone else. It's not the same as a late fee. It would just be a specific kind of credit arrangement with another party that's accumulating interest. So then you've got income tax refunds that could be in this area, and also profit or loss from the sale of assets. So this could be basically an other income or other expenses. It's not really a big deal either. Now, other expenses are going to be interest that you get charged on credit cards and stuff like that. Again, not late fees on bills. So not the same thing. Interest expenses, credit card interest, loan interest, lease interest, things like that. Things that are not bringing down your liability but are charged as a financing expense. Then we have income tax that could be an expense in this section as well. And that's because it's not tax deductible, but also it's not a part of the day-to-day operations. It's just an extra expense that you want to count in there. So then depreciation and amortization is also in this section because it's not about what's happening in the day-to-day operations for the business. So that's pretty much the layout of each of the statements. And we'll get into things like EBITDA real quick. So EBITDA, and I always get the letters mixed up. I always mix up the T and the D. EBITDA is an acronym. It means earnings before interest, tax, depreciation, and amortization. So if you set these up correctly, then EBITDA is basically just going to be all of this section, the operating revenue or income and the operating expenses. So that's what EBITDA is. You'll hear that a lot, mostly in higher up conversations or financing.